Hi and welcome to pallavijhastocklens. If you're going to look at Infosys, on Tuesday, that is 9th of September, Infosys shares jumped 5%, and on 10th September, at the time of recording this, Infosys shares rose around 2% in trade. So this is ahead of the board meeting wherein share buyback proposal is going to be considered on 11th of September. So Infosys is going to consider its first buyback in 3-year period, and after 2022 this is the first buyback by Infosys, and since it got listed in 1993, this is Infosys' fifth buyback. So going by history, on an average what you see is that Infosys spends around 30% cash on buybacks and it buys back around 14 to 15% of its net worth in a stretch. So 30% of cash and cash equivalents amounts to 30% of 45,200, which comes to 13,560 crores, and 14 to 15% of net worth, if you're going to see, which is 95,350 crores. So 15% of that is around 14,302 crore rupees. Okay, so the company may have to spend around 13,560 to 14,300 crore rupees, that is in the 13,000 crore 14,000 crore range for the buyback, and the buyback price it is at an average premium of 25%. So if you see Infosys, it has conducted 4 buybacks from 2017 to 2023, and the current buyback may provide a cushion to macroeconomic volatility. The share buyback is a part of the policy of capital return that the company announced in Q4 of FY24. So now you might think, how come buyback can help macroeconomic volatility? Okay, that is, how can buying back portray itself as a cushion to macroeconomic volatility? So for example, when there is global slowdown or inflation or currency swings, currency volatility, uncertain IT demand, in these situations, how does buying back help? The first thing is that it supports the share price. How? Because when Infosys is going to buy back shares, the demand for the stock is going to go up, which usually helps the share prices stay stable even if the broader markets are shaky. So in that way, the share price will remain stable and it supports the share price. Second thing is that it boosts investor confidence. Why? Because once there is buyback of shares, investors feel that the company's operations are good, it has enough cash to buy back, the company is strong, the company is generating enough cash, and that the company is confident about its future and its operations. So this is going to help reduce panic during uncertain times as of now. Correct? And after buyback, what's going to happen is that shareholders to that extent are going to reduce to the extent shares are bought back. Correct? So because of that, what's going to happen is that there's going to be higher returns to the remaining shareholders, because of which earnings per share is going to improve, is going to increase, and high EPS is going to make the stock look more attractive even when economy is uncertain, which is the current scenario because of Trump tariffs, right? So essentially what's going to happen is that Infosys is using its cash pile to buy back so that the stock remains strong, and this in turn acts as a safety cushion for investors against the existing economic uncertainties or economic shocks. Okay, so Infosys is expected to return 85% of free cash flow cumulatively over a 5-year period. Okay, now this is important. 85% of free cash flows is going to return over a 5-year period. How is this going to be done? Through a combination of semi-annual dividends, share buybacks, or special dividends. All this has been told by the brokerage firm Morgan Stanley. Okay, so Morgan Stanley has said that it is expecting 1.3 to 2% share buyback of the total equity. So according to Morgan Stanley, they also say that they've explained in 3 scenarios. So what they say is that if a 21.6% upside is applied, then the target price for Infosys would be 1,743 rupees. If a 45.5% upside is applied, highest target price for Infosys would be 2,085 rupees. And if the lowest, that is 0.5% of upside is applied, the lowest target price for Infosys would be 1,440 rupees. So in last 2 years, if you're going to see, this is the first buyback from a leading IT company. And TCS and Wipro, they've done 5 buybacks from 2016 to 2023. So if you're going to look at the economic scenario, due to worsening macroeconomic conditions, what's happening is that because of tariff tensions, because of rupee depreciation, IT stocks, IT index is under tremendous pressure. And generally, if you see for IT stocks in the long term, unless this US tariff issue is resolved, these IT stocks are going to be remaining under pressure. So IT index as a whole, if you see, it's fallen down 21%. And Infosys as a stock, if you see, it's lost value of around 24% on year-to-date basis. And in the past 6 months, if you see, Infosys stock, it has also underperformed compared to its large peers in the industry. So now with this buyback, what's going to happen is, so Infosys stock is likely to find support because of this buyback. Why? Because with this buyback, there's going to be a picture of stability that will be portrayed. Okay, and secondly, there's this reiteration picture that's going to be portrayed, that steady annual revenues and margin guidance is in line as it was expected earlier with the forthcoming results that are going to come. Okay, so Morgan Stanley, they are equal weight on the stock. Now, what is equal weight? So when a brokerage firm gives an opinion that they are equal weight on a stock, that means that the stock is expected to perform similar to that of peers in the industry. Okay, so if a brokerage house gives overweight on a stock, what that means is it's a strong buy recommendation. And if a brokerage house is giving the opinion that it's underweight on a stock, it means that it's a strong sell recommendation. So equal weight means what? It's neither a strong buy recommendation nor a strong sell recommendation. Okay, so a rate cut in the US is positive for Indian IT firms, which earns a significant portion of their revenues from the US, as it could revive technology spending. Moreover, rate cuts in the US are positive for emerging markets like India, making them more attractive to foreign investors. Okay, so a rate cut in the US is positive for IT firms. Why is that? So in the first place, why Indian companies care about the US is that because big firms like Infosys, TCS, Wipro, HCL, etc., they earn a large share of their income from US clients. And who are these clients? They are the banks, the retailers, the healthcare companies, the tech chains. So all of them are based in US. So if US companies spend more on technology, then Indian IT companies get more business. So what happens when the interest rate is high is that, so supposing there is high interest rate in the US economy, so because of which the borrowing becomes costly. Okay, so when money is costly in the US companies, what they'll try to do is to save cost, to cut cost, and often they delay or reduce spending on IT projects. And investors, on the other hand, they also prefer to keep the money in US because they're getting higher interest rate there. What happens in that case? Emerging markets like India, they get to see lesser reduced foreign investment because money is kept in US banks and they do not move out of US. But what happens when US interest rates are cut is that borrowing becomes cheaper for the US companies. So now that interest rates are considerably lower, borrowing becomes cheaper for US companies. So now there is more room to invest, to spend, and there's also more money to invest in technology. Okay, so what does that mean for Indian companies? Now that rates are lower, now that interest rates are lower, and now that US companies are willing to invest in technology, therefore there'll be more IT contracts and projects for Indian IT companies, and there'll be inflow of US money into India. So that is the benefit Indian IT company has. Okay. So from an investor's perspective, if you see, because of considerably lower interest rates, now instead of US, they'll be looking for options where they can get higher return on their investments. That is relatively higher return on their investments. Okay, so because of which they will look at fast growing markets like India where they can get better returns. And subsequently, what happens is there's increased foreign investment into Indian stocks and bonds. Okay. So why is US interest cut good for Indian IT firms? Because it encourages US clients to spend more on technology that benefits India. And secondly, it makes India more attractive for foreign investors because it boosts demand for Indian stocks, including IT stocks. Okay. So there is both direct and indirect benefit. Direct benefit is that there is more US spend on technology, which means there is more revenues for Indian IT companies, Indian IT service providers. Whereas indirect benefit, if you have to see, more foreign money that is flowing into India. And because of lower interest rate in the US, and they're looking for better return on their capital, which is why they look for emerging markets like India where they can get better returns. Okay, and because of which When foreign investments flow into India, Indian stock market sentiment improves, and because of which Indian IT stocks may also improve in value. So that's it for this session. See you in my next session. Subscribe for more such videos.